Hi, this is George IRR Martin. Today I want to share my next investment idea in Fiserv Inc., ticker symbol FI, currently trading at $130. This pitch was long overdue, but fortunately for you, the stock has only traded downwards. It's now near its 52-week low, making it the perfect entry point. But before I dive deeper into that, none of this is financial advice. Do your own research and always consult a licensed financial professional before making investment decisions. Okay, so Fiserv. Fiserv operates in the payments ecosystem. It's a very complex space, lots of different players, lots of different roles to play. I won't really get into all those roles. But Fiserv pretty much is involved at almost every single level of the value chain. So from the point of sale systems to the core processing software used by banks, they have their own PIN debit networks, lots of software and systems that make payments happen. And to me, that's really the main unique value proposition that Fiserv gives, that they're a single platform that you can turn to for all your payments needs. Couple years ago, they acquired First Data to kind of, fully vertically integrate the payments operation. It was a pretty big transaction, and it helped them acquire some very interesting assets like Clover. More on that later. But a good concrete example of the value that Fiserv gives is Cell. So Cell is not owned by Fiserv, it's owned by a bunch of banks, but those banks built Cell using Fiserv's technology, and Cell still runs on Fiserv's technology. So Cell allows you to send money in a very efficient way to other people, sort of like Cash App or PayPal, except you can send money directly from your banking app. So you don't need to go to a third party and make an account there and then send to someone that has an account there. You can just send directly from bank account to bank account. This has taken so much market share from Cash App and PayPal, and it's been a winning formula, right? So Fiserv is not competing with the banks. It's giving them the technology they need to compete against these fintech companies. And ultimately, Fiserv divides all their business operations into two buckets. One is merchant solutions, that includes point of sale systems, enterprise software, cash flow management software for small businesses and their enterprise merchants. That includes Clover, which is their fastest growing, more visible business line. But it's also a business that's very competed by other players. So we see Toast, we see Square, we see PayPal, we see lots of different names competing here. The other bucket is called financial solutions, that provides mission-critical software and core processing for banks, credit unions, lenders. This is a lot more recurring revenue. They do have some competition, but once they acquire a customer, they have extremely low churn rates. We're talking like 99% retention. It's very sticky, very durable, higher margins, higher pricing power. All of this means nothing if I don't provide data, and the ultimate way to test a business quality is through return on invested capital. So if you look at the headline ROIC, you're going to see some pretty mediocre numbers. So I'm talking about 10%, 12% for this year. We are seeing incremental ROIC, which is always great to see. However, that's pretty mediocre. But the big reason that number comes out very low is because of the goodwill from the First Data transaction I talked about. So they have around $37 billion in goodwill from that transaction. Goodwill is important. I don't believe that you can just ignore it. It's important for management to, be prudent in their investments. But if you're willing to strip goodwill out and just focus on the actual core assets of the business, you're going to have very, very high returns on investment capital. So we're talking about almost 40% for this year by my math. And if we look at it from the capital structure perspective, you're still going to get 30% on your return on invested capital ex goodwill. So that shows you that inherently the inherent returns on capital are very high, which show you that this is a very high quality business. 30% ROICs are in the same ballpark as, a Visa, a MasterCard, an Apple. These are just well-known, very high-quality businesses. And if we take a look at just comparing these returns on capital versus other competitors, here I'm using a very similar metric, but the math comes out different. But it's just to give you a picture. Cash ROIC, it's going to be 28%. For Fiserv, for PayPal, it's 10%. Okay, for Block, it's going to be 12%. And this makes sense when you consider, again, what I talked about, that Fiserv is not really competing head-to-head against these different payments providers. It's giving a unique solution to financial institutions, to merchants, and it's really leveraging those network effects to have superior returns on capital. Now let's go to valuation. Bottom line is that the market is not pricing this in at all. It's giving you a lower multiple than even a Block or a PayPal for the whole business. So we can see that revenues for merchant services and financial services are about the same. Let's call it 10 each, 20 billion in revenue. They had an EBITDA of 10 billion. Margins for financial services are going to be much higher than merchant services for all the reasons that I already talked about. So financial services a lot more sticky, less churn, less competition. Merchant services, it's more you get more competition, but you're also getting higher growth. And if you're willing to look at their peers, so for financial services, I'm thinking Jack Henry, very high quality company there, trading at 15 times EV to EBITDA. FIS, 10 times. You do see an upside there for the multiple. Even if you look at some names like PayPal, Block, or Adyen, which is growing a lot faster but still the same business, I think there's a strong case that there will be a multiple normalization, right? So that's this 10 times EV to EBITDA is almost an all-time low for Fiserv. So if you're willing to extrapolate growth at 8% for merchant services, 5% for financial services until 2030, and that multiples will normalize, you're looking at over 2x on your investment. Okay, if you take into account their dividends and buybacks, I'm calling it 2% yield per year, you're going to have a 5-year IRR of 18.6%. Why does this opportunity exist? I think, the whole payment space has been sold off. The market is discounting it as, a very high competition, low growth space, that it's been commoditized. But again, if you look at the numbers, you look at the returns on capital, you look at the margins, and you look at the revenue growth, a 7% a year, that's not nothing. I think the market is clearly undervaluing this business. At the start of the year, this was trading at $240, and it's just completely sold off because of revenue growth disappointing. But again, this isn't a growth story. This is a high-quality franchise, great businesses with lots of margin, lots of returns on capital, and the market has just completely thrown it in the trash bin because its growth disappointed at the start of the year. And this brings me to this chart I prepared, which goes a little bit into my investment thesis. Basically, as a value investor, you assign a valuation. First, you identify good quality, high quality businesses. Those there are not a lot of those. You can probably get to 100 or 200 names of U.S. large cap high quality companies, and you try to assign a valuation to each. Most of the time, the market is going to be above that valuation, but then something is going to happen, some sort of catalyst, some bad news, sometimes a sector-wide sell-off, and you're going to get opportunities like this. And this is when your patience pays off and you dive deep. So by my math, the company is currently trading at a 35% discount to its intrinsic value. And that provides a great entry point into a high quality name that's going to continue compounding in the future. Again, my projection is an 18.6% IRR over the next 5 years. That's almost 10% over what the S&P historically gives. That's a non-brainer in my view. I think that there's not any systematic reason why this sector is just not going to continue existing. I don't see that. I don't think anyone sees that. It's simply that the market has completely given up on the sector, and you have a very high quality name here. That's all I had for you. I hope that made sense to you, and as always, on the lookout for comments and feedback. Thanks.